They can't keep up, folks. They can't keep up. And this guy's one of the reasons, right? Let's bring a Roundhill Investments, their CEO, Dave Mazza. And Dave, before we get into all the industry stuff, I want to start off with the stock of the day, right? Because you guys, knocked the cover off the ball with the DRAM thing, your ETF, and SanDisk. Now, SanDisk has been all over the place. Obviously, it's had a huge move. More recently, though, it's come under some serious pressure. What do you make of it? I mean, it's a juggernaut, but it is starting to struggle here.
Yeah, well, the memory theme, particularly SanDisk's, has gone through a cycle basically in the last 6 weeks, right? We saw euphoria, we saw a pullback, and then we've seen a bit of recovery. Last night's earnings results were great on one hand, but not great enough because the expectations were so high. And I think what we're still seeing is whether it's the situational awareness situation, the deleveraging that's happened with Korean retail investors, that these memory stocks are going to need to shake out a little bit. The one thing I'm looking at with SanDisk is their August 13th Investor Day.
Okay, yeah, by the way, that's one of the reasons, I'm glad you said that. One of the reasons I don't think we need as many earnings reports, these investors' days and these conferences give us a lot of transparency and move stocks on fundamentals, not this, hey, got into it. We thought you were going to make $54.2 billion, instead it's $54 billion. Now you're down 20%. Let's talk a little bit more about this because this whole memories place now, these guys are getting these long-term contracts, these 5-year contracts. They cover a lot of things. You've got, for instance, Hynix with 10 of them. How do you feel about that? This was supposed to smooth out the sort of the volatility in these names.
Well, I'm glad you used this chart because this is something that I love because it's actually spelling out specifically what you just said about how this sector is moving from the cyclical nature that it historically was to locking in long-term agreements with customers, which provides a floor to the pricing, in some cases a ceiling, but allows investors and the companies themselves to have more transparency into where their revenue is going to come from. And we heard from last night's SanDisk, again, they actually locked in 5 more of these agreements.
Right. I mean, this is what we thought the street wanted. I like you said, AI investing cycle. Right now, when it comes, it was about owning. Now it's about connecting, and eventually it'll be about renting. Let's go through this, right? Because we'll start with the connecting part here. And you've got well, actually, let's debut. Let's debut the new ETF, LYTE. This is where it's at. Talk to us about this, because still, even though I've been hitting this for about a year on the show, this Photonics, optical, talk to the audience about it.
Yeah, this ETF is brand new. We just launched it today, and I'm happy to be here to kind of launch it for everybody because these are companies, particularly we look at Luminite Coherent, that you've been talking about for a long time. Some investors have picked up on, but not everyone. And one of the reasons why I think there's still a sort of a misperception about this is just like memory was a bottleneck, in order to make these hyperscalers, these data centers work, we need to have greater and faster connectivity. And copper historically was the solution for that, but it's just not as fast enough because the chips are so much faster, and these companies are at the pioneer of providing those solutions for these data centers.
Right, and the amount of copper, which is at a high, that has to be used is just mind-boggling. And of course, the longer the distance, the better the light is, or optical. I do want to ask, though, because you have half of these are Chinese names. The administration is talking about blocking or banning these names. How would that impact the industry? How would that impact the ETF?
Okay, so this is an interesting point because we really sort of support the idea that the American economy needs to have more industrialization. We need to be making more things at home. Here's the challenge with this proposal, is right now, 2/3 of the world's supply for these particular connectors and parts come from these Chinese companies.
Right.
And so if we want to continue to be the leader in hyperscalers and AI, we can't just shut that off now because we can't put Luminite and others can't bring that online today.
We don't have the capacity. There's too much demand, and the bottleneck would get even tighter.
Correct.
If we just did it overnight, wham, bam. It has to be a process. At some point, maybe we would favor Americans, but not just shut them off China overnight, because it would make the problem even more acute.
Exactly. It's going to make it worse than better right now.
Let me ask you about Neocloud. You say it's a landlord of the AI boom. Of course, you have NCLD, that's your ETF. These are the names you like the most, particularly Nebius.
Yeah, Nebius is a name that we've liked for a long time in our generative AI ETF chat, which we talked about before. But we wanted to create a dedicated ETF just for the Neoclouds because the demand for compute is only increasing. Of course, we know about the hyperscaler CapEx, but you know who some of the biggest customers of Neoclouds are? It's actually the hyperscalers themselves, because they have the compute that they're able to bring online in a much shorter time period than actually cloud providers can do.
So you mentioned Korea at the top of the show. over there, the government officials there have just a lot of sorrow. They're saying, you know what, we allowed these leverage ETFs to come in too quickly. We fed a feeding frenzy. And I want to ask you about that. The role of leverage ETFs, these single stock ETFs, hit 200 billion. We had a little bit of sell-off here too, to your point. That's why some of these hot stocks got hit. What do you think? I mean, do they go too far? Can they go too far? Should we have 2, 3, 4, 5 times leverage?
I think the regulations that we have today sort of spell out that there were some grandfathered 3x funds, and then now it's really 2x. But the bigger point, I think, is the number of single stock leverage and inverse ETFs that have come to market. It's one hand if you're amplifying exposure to the NASDAQ, S&P 500, maybe even memory stocks, because we're talking trillion-dollar market cap companies.
Right.
But when we're doing single stocks on smaller companies, it can create a bit of a tail wagging the dog situation, and it can amplify volatility like we've seen. So these are tools for someone who can trade and make a decision about buying, selling, hold on a daily basis. But the number of funds out there has begun to change market structure a bit, and investors need to not just think about the fundamentals, but understand the positioning and the influence of leverage ETFs along with zero DT options,
right.
Perpetuals, and other things of that nature, which can influence prices in the short term.
It feels more like gambling, though, to me, like some of it, you know what I mean? Or we see that it's just, listen, I want people to have all the options out there, but I worry about them going too far. I love the way you explain it. You're a straight shooter. Light, L-Y-T-E, that's the new one.
Yes, that's right.
All right, folks, take a look at it. Remember, he killed it with DRAM. See you soon. All right, folks, coming up, the great Art Hogan. He's been